Good morning, this is Ken Long at Tortoise Capital with an executive summary review of the washout swing trade pattern. This is one of my favorite patterns because it really illustrates the power and the importance of beliefs. And so let's begin with the notion, what if everything you knew was wrong? And so this thought occurred to me in the back of one of the Van Tharp Institute workshops where I was taking some notes in the back. And I was listening to Van talk about the power of beliefs, and I said, well, let me just try a thought experiment. Let me list everything that I think I believe in if I were to listen to the media or conventional wisdom. And then let me take the exact opposite of that belief in order to test Harry Truman's idea that it's not what you don't know, it's what you know that ain't so that gets you in trouble. And so I made a quick listing of beliefs, and I said under conventional wisdom that you should stay with the trend, ride the trend. You should look for the strongest stocks in the strongest sectors, that you can't pick bottoms, so don't even try. You should buy them when people hate them. You should have the courage of your convictions, and you should respect the idea that small caps outperform. That's why they have that little risk premium. So I decided then to write the polar opposite of that and say, all right, what if I had a strategy that tried to avoid the trend and look for the weakest stocks in the weakest sectors, and I tried to pick bottoms. And then the opposite of hate is not love, but indifference. And I said, well, what if we buy them when no one else cares? And what if I'm always afraid of these beliefs and I don't trust this system at all, and I'm very nervous to get out? And what if I focus on large caps instead? What would this kind of a system look like? I put an affirmation on it, an affirmation, and asserted that, well then, what I should be trying to do would be to buy weak large cap stocks in weak sectors when nobody cares about them anymore, when everyone who is going to sell has sold, when there is price evidence of short-term improvement. I should buy them when the market is going up, and I should even buy them if they're going up like that and the market itself is going down. I should plan for the most recent swing high as a reward to risk ratio of 2-to-1. Nothing in my belief system allows me to suspend the importance of that reward to risk opportunity belief. And so I included those two lines. And then I would cut and run at the first sign of hesitation. I would not have the courage of my convictions. I would be quick to exit. And I would look for signs of institutional interest, because I'm talking about large caps here that have been beaten down. And institutions are not trying to get the absolute best price, but they're trying to buy recovering symbols when they have undergone some repair at a moment of value, when they are sold off more than is warranted by the fundamentals. And so watching for signs of institutional interest is what would help me believe that others, and not just me, were starting to see the value in these symbols. So that's the set of beliefs that I want to use. Now, let me operationalize these beliefs, by which I mean let me put them into something that I can code or pseudocode and define with some precision. So I want to buy the large caps, so that would be the OEX or S&P 100 symbols and large cap ETFs, very liquid ETFs. And that's where I get the institutional money potential and a certain amount of risk management, in that I don't think they'll go to zero overnight. Not that they won't go to zero, go out of business, but on a swing trade basis, I have some belief that they could last long enough for me to get out at a price better than zero. Now, to buy them when long-term sellers have sold, what I'm going to use is Williams percent R260. That's a year's worth of data. And it has to be less than minus 80, meaning that it's extremely oversold on an annual basis. And then I want them to be oversold on a short-term basis. So Williams percent R10, a 10-day look back, is also less than minus 80. And so now I've got targets that have institutional interest in them with a built-in risk management in the fact that they're so large, that long-term sellers and short-term sellers may have sold. And so when we look at the Williams percent R, it would look like this, that we're deep into the oversold conditions. And now I want to look at price patterns for the setup day and then the entry day, because I'm going to be the second mouse on this one. And when I say second mouse, let me pause for a moment and talk about Williams percent R, and show you what I mean. So this is my belief about price patterns and populations of interest when it comes to trading symbols on the basis of what the rest of the community of practice is doing. So this comes from the work by Malcolm Gladwell popularizing the behavior of crowds. And so if we had a symbol that had been very strong and then had a measured pullback and then was starting to improve, in other words, a resumption of that primary trend, and a retest of that previous swing high would represent 100% pullback. And if we drew a line at 50%, we could then ask ourselves, how much of a pullback is significant? How much of a retracement is an indication that this move may be resuming, as opposed to just simple noise that would be part of this selling condition? Well, I propose that there are 5 groups of guys who look at this standard price pattern, which we will see in the 551W and in the triple screen, and group them like Gladwell does into innovators, early adopters, early mass adopters, late mass adopters, and grumpy old men. And so I'm going to describe groups 3 and 4, the mass adopters, as institutional money, big money, that waits to see some amount of retracement before they are ready to get back on board, and who can really move the market all the way back to the swing high and beyond because of the size that they're slinging. Grumpy old men, these guys at the end that wait for things to get well past the 200-day moving average before they're convinced it's time to join, and who in the year 2016 may now be starting to think about using this email stuff or possibly the internet. And so that gets us back to these first 2 mice, the innovators and then the early adopters. The innovators are guys who see the red line as an opportunity, and when they see the statistical sell-off that seems to be significant, they're willing to buy it on the statistic that this is an exceptional down move, and so therefore value has been created, and so they buy it without evidence of an actual retracement. I think of them like mountain climbers. I think about mountain climbers that there are old mountain climbers, bold mountain climbers, but no old, bold mountain climbers. And so I'm willing to let group 1 make this first set of purchases in here, and I'm going to be part of the second group, the early adopters, who start to buy after some evidence that this sell-off has stopped and started to rebound. And then the power of this longer-term trend, I know, will be attractive to groups 3 and 4. I know group 5 will be interested after it's made a new high. And so my job is to find this sweet spot between the young, bold scouts who take the first positions and try to create the bottom, and the early mass adopters who want to buy below the 200-day moving average in a schedule of buying so that they can later on sell to groups 4 and 5 and make their difference by getting in just a little bit earlier. So if I can get a position which is then supported by group 3 when they come in, then I'm going to be in good shape. And so when we see a Williams percent R retracement down to minus 80, we can say that for that look-back period, more people are going to look at this as an oversold condition than otherwise. And so we may be tempting groups 1 and 2 to start entering, and maybe group 3 is measuring the value that was created during this unexpected sell-off. And so that's why oversold on a percent R basis is so attractive to me from a population and psychology basis. So now back to the washout. So here we are looking at what a Williams percent R would look like for both the long-term and then the short-term look-back period. Williams percent R is computed by placing the highest high of the look-back period at a value of 0, the lowest low at a value of minus 100, computing 100 equal increments along the way, and then determining through math the value of price as compared to that index scale of 0 to minus 100. And then values at minus 180 or minus 80 to minus 100 are in the bottom 20% of that look-back period's price, and between minus 20 and 0 in the top 20%. So we would count this as oversold, this as overbought, with the midpoint being the 50-yard line between those two conditions. So what we're looking for in Williams percent R to establish the oversold on a long-term and short-term is each of those indicators down here in the oversold conditions on the setup day. Now on a setup day, what we're going to do is wait to see a day that closes that gives us some indication that a bottom may have been put in and that the first mice have succeeded perhaps in hammering out a swing low. So let's say that whatever caused this target to sell off so dramatically on an annual and on a 10-day basis, well, let's just call that the big sell, and represented by this big red candle. This probably has taken days, weeks, and months to occur, and but this big red candle shows the magnitude of the pain from whatever the previous trend was, and then the big sell occurs, and it terminates in something that looks like a swing low. Now, the day that we care about is the next day. After a new low has been made, we wonder if this day, is when it closes, if it can be described as a setup day. So for that to occur, we have to pass 3 tests. The first one is that we have to see a higher low on the setup day. So here we notice that this low of the day is higher than this low, so test 1 is approved. It had a higher low. And then we want to see that the close was greater than the open. In other words, it was a white candle. So here's the open, here's the close. So in fact, it closed higher than it opened, and guys are willing to hold it overnight with that higher, with the close higher than the low, or close higher than the open. So that gives us the white candle. So second test. Third test, the close is greater than yesterday's high, and this one is important. Because what I want to see is the psychology shift such that people are willing to hold this at a price level higher than they were even able to get to it on the previous day. That's an important psychological moment. If this guy was not willing to hold it overnight, he would have sold it, and the additional selling pressure of all those people might have pushed this closing price even lower and maybe even invalidated some of these rules. So the fact that we're able to close and hold it overnight at a price that was greater than it even got to the day before, I consider that to be a positive. So we've got 3 things that create a setup day out of this white candle. A higher low, 1. A white candle, close greater than the open. And then 3, most importantly for me, the close was greater than yesterday's high. Those are 3 pieces of evidence that I can infer have led to this swing low day being perhaps the swing low during this swing trade time frame. I'm not saying this is going to go on to do great and wondrous things because I don't believe in this trade, but for a swing trade time frame, until such time as the institutional money starts coming in, we have the potential of a bottom being put in and now a recovery of some magnitude off this swing low. So now the second day will be an entry day if it opens inside yesterday's range and then proceeds to take out yesterday's high plus 5 cents or a buffer of your choice. I use 5 cents. And on that momentum, I'm willing to take that as an entry so long as it has not made a low below the swing low. So this is an entry day because it opened inside yesterday's yesterday's range, and had an orderly move and took out yesterday's high plus a nickel. So we're buying second day momentum. Now here's how this rascal works out with institutional money coming in. So here's the big sell, and we will say that at some point we've identified a 10-day high over here for price targeting. And then we have the swing low down here in this red candle, and this second candle you can see is a setup day because it passes all three tests. We have a higher low, test 1. It's a white candle, test 2. The close was greater than the open. And number 3, it closed at a price greater than yesterday's high. So that makes this a setup day. So I'm ready to buy this 5 cents above yesterday's high. Here it is opening inside yesterday's range in a nice orderly manner, and it makes a new high, takes out yesterday's high plus a nickel. So I buy it at the green line, and my stop is the red line below the swing low, because that's the price that tells me this move is over and that whatever was creating these previous downward swings is still in force, because we have a new lower price. There's still negative emotions associated with that. But if it doesn't take out that low, if we do get this entry, there's some considerations. I will consider using an ATR stop rather than the swing low if this move off the bottom is more than an ATR, because then I feel like an adverse ATR move here, or greater than ATR move, would be enough evidence to tell me that this failure is occurring, that I don't need to see a price all the way down here. But in some cases, the distance from the green line to the red line may not be a full ATR. So I will consider using either an ATR or a price below the swing low. In this region from my entry until this measured swing high, I use a trailing stop of whatever my initial stop was until I get to this next swing high, and I usually use the 10-day high for this. Now here's what happens at this 10-day high. The move from the swing high to the swing low could very easily have been a 5 to 8% move in the last week to 10 days. The recovery move off the bottom to retest that 10-day high could also be 5 to 8%. An 8% move off a swing low might be sufficient rebound and buffer for institutional investors to start making a decision to come in. This star represents the military decision symbol for decision point. And so when the price has rebounded to the previous swing high, and we have something like that 8% buffer, for example, off the low, that may be the point where institutional money decides it wants to come in. So it hasn't failed further in this 1 to 10 days while this swing trade back to the swing high was unfolding. That may be enough to start a buying program initiated at the big institutional money. If we see that, what I take as evidence of that behaving, or that developing, is a failure to fail at the resistance level, and that it powers through there and off it goes. If I see price then get through this swing high, I'm beginning to believe that institutional money is seeing this as a potential, and now this could be the beginning of a really good swing as it claws its way back to whatever price it was at before the big sell. When we look at the washout pattern, mechanical statistics traded in that way from September 07 to March 08. That's a period of about 8 months. We had 91 trades. We had 57 winners, 34 losers. That gives us about a 0.69 reliability. The average win was 2.12 R. The average loss minus 0.7, so a pretty good payoff. The biggest win was a gift of 16 R. There was a favorable gap, and off it just went on a tear. The biggest loss was minus 1.42. You can see the profit factor in the total and the net R and the system quality numbers, and then the histogram of the system. Now this histogram has all the qualities that I look for in a histogram of results. A very tightly controlled left-hand side, a normal looking distribution of winning trades, which between -1 and +2 is positive expectancy, and then the possibility for outsized gains compared to losses, so a fat right tail, and that's what we have here. Now, this occurred inside a bullish condition, bullish market condition. This was a bearish market condition from 07 to 08, from September 07 to 08. And so the reliability level went down a little bit, but we got a lot more opportunities. So for example, in this period, from what I should have said, from January 06 to December 07, that's 24 months. And that got 112 trades. So that's, roughly 56 trades a year. This one had 91 trades in 8 months. So in a bear market, you have a lot more things failing, so you're going to get more washout patterns. Your average R winner drops from 2.1 to 1.7. Average loss goes from minus 0.7 to minus 1, but you get so many more opportunities that you actually get a really good system quality number and some good R's manufactured. It fails more, less wins on the upside, slightly larger losses, but the increased number of opportunities gives you a very favorable expectunity. So the washout pattern, and this is going long on those horrible symbols inside a bear. And then if you take a short position when that red line is hit, so you put the trade in, or the trade never gets through your entry and just immediately fails through your red line, makes a new low below the swing low, you just get short at that point, and that's an even better system. So the bear systems with the washout pattern are very favorable. So this is kind of not ironic, but an interesting example of the power of beliefs and what can happen when you just suspend your own disbelief and take those beliefs, operationalize them, put them into pseudocode with precision, and then study the trades and then look at a large enough sample that considers market classifications as well, and see what you can do. And so what started off life as a thought experiment has now become one of my bread and butter patterns for trading ETFs and large caps, and it's robust because there's ways to trade this in bull, bear, and sideways. So I will leave it to you to study the different initial exits and the initial risks that you can take. And on this one, you really want to pay attention to the 2R battle drill and not believe in this trade at all. It's very important for you to cut and run at the sign of weakness. Don't stick around. Don't have the courage of your convictions. Don't believe it's going to work. Just simply follow the management rules and be ruthless. Ruthless risk management is the key to survival with the washout pattern. And the washout continuation is perfectly satisfying. And the washout failure in bear markets is also a good module to add on to. So, Ken Law from Tortoise Capital. This has been the washout pattern. Good trading.